So now we'll be looking at Dargent Go, which is a question that is coming from the March June 2017 ACCA F7 paper. The question requirement is for us to prepare a consolidated statement of financial position for Dargent Co. as of 31st March 2006. So when you prepare a consolidated SOFP, the first steps that you need to be following is you put down your formats. So I have put down the format of the statement of financial position, and then I put some workings that is required. So we have the 5 standard workings that we have to work with. And then when you have a consolidated statement of financial position, you will be doing line by line consolidation, which means you will be combining the parents figures and the subsidiaries figures together. So the property, plant and equipment that you see here is basically the 75,200, which is the property of Dargent Co, plus 31,500, which is Luttrell Co's property. So we have combined them together and you will have 106,700. So I've taken line by line consolidation and all of that work has been completed. So now I'll start working on the question. To begin with, on 1st of January 2006, so this is a key thing that you should be focusing on. So the acquisition date is on 1st of January 2006. Now our financial statements are given for 31st March 2006. So you're looking at Dargent and Luttrell, the group structure. So we have owned Luttrell from January to March. So January, February, March. So we have only owned Luttrell for 3 months. So we only have 3 months ownership on Luttrell. We acquired 75%, which means the non-controlling interest of Luttrell Co is going to be 25%. Shares by means of a share exchange of 2 shares in Dargent Co for every 3 Luttrell Co shares acquired. So we need to see what is going to be the amount of shares that we have issued in terms of Dargent. So the number of shares that we have acquired of Luttrell Co. So the share capital is going to be 20,000. So we have taken 75%. So that means we are looking at 15,000 shares. So shares acquired is going to be 15,000. We need to see how many Dargent shares issued. So 15,000. The basis is we are given 2 Dargent shares for every 3. So it will be 2 over 3. So we will be issuing 10,000 of Dargent shares. On that date, further consideration was also issued to the shareholders of Luttrell Co. in the form of $100 8% loan notes. So we are giving 8% loan notes, $100 8% loan notes, and that is going to be for every 100 shares. For every 100 shares acquired in Luttrell Co. So for every 100 shares that was acquired, there is going to be loan notes that is going to be given. So the loan notes issued, so that is 15,000 divided by 100. So we will be issuing 150 loan notes. Now the value of the loan notes is going to be 100. So the loan notes value in dollars, that is going to be 150 into 100. That is going to be 15,000. None of the purchase consideration nor the outstanding interest of the loan notes at 31st March 2006 has yet been recorded by Dargent Co. So that means for this acquisition, right, we have not recorded anything in the individual financial statements of the parent. So we do need to record all of these values. At the date of acquisition, the share price of Dargent Co. and Electric Co. is 3.2 and 1.8 respectively. So Dargent Co. shares the share capital that was issued is going to be, the nominal value of a share is going to be $1. So 10,000 shares at $1, it would be 10,000. Then you will have the share premium that needs to be taken. So 10,000 shares, the market value of a share is 3.2, whereas the nominal value is 1. So 2.2 is going to be the premium per share. So you'll be seeing 22,000 coming from the share premium. So overall from the share issue, 32,000 is going to be the investment that we have made in Electric Co. So you have two investments. One is on the loan notes of 15,000 and you will have the share issue of 32,000. Now none of these was recorded in the financial statements. So we have shown the parent share capital here. So we need to add 10,000 to the parent share capital. So it will be 50,000, which is the parent share capital according to the statement of financial position, plus the 10,000 which is coming from the new share issue. Then you will have the share premium coming in. So the share premium is going to be 22,000. So we have accounted for the share issue part of it. The next is we need to account for the loan notes. So the loan notes, we have already issued 5,000, which is coming from the statement of financial position. To this we need to add another 15,000. So my loan notes will go up to 20,000. Now the loan notes interest was also not accounted for. So I need to take the loan notes interest. Now the loan note interest, we have not accounted for the new loan notes that was issued, which was 15,000. So the annual interest is going to be 15,000 into 8%. So that, sorry, it will be 15,000 into 8%. So that's 1,200. Now we have only had ownership of the subsidiary for 3 months. So it will be 1,200 into 3/12. So that is going to be 300. So this amount is accrued. Now under current liabilities, you need to take the loan interest accrued. So there is going to be an accrued interest of 300. This is going to be a part of the expenses. This is an expense of the parent. So as a result of this, the parent's retained earnings will decrease. So this will be adjusted in working number 5. So you will have less the finance cost. So the finance cost was 300 for the loan notes. So with that, we have dealt with the first part of the paragraphs. We do have some adjustments that we need to do. Later on, we'll have to revisit this area, right, when we start doing the workings. We'll look into it later on. So Rest is basically your financial statements. So let's move on to the notes that is given. Now, at the date of acquisition, the fair value of Latrico's assets were equal to their carrying amounts. So on the date of acquisition, their carrying values are equal. So that means there is no fair value revaluation reserve coming in. However, Latrico operates a mine which requires to be decommissioned in 5 years' time. No provision has been made for the decommissioning cost by Latrico. The present value of the decommissioning is estimated at 4 million and will be paid 5 years from the date of acquisition, which is the end of the mine's useful economic life. So now this basically means I need to consider the decommissioning cost. So I will have the decommissioning cost which will be taken to your asset, and I also need to maintain the provision for the decommissioning cost. Then the present value of the decommissioning cost or the future cash flows is valued at 4 million. So if we have taken the present value, that means we will need to unwind the discount, where we will be looking into a finance cost coming in from this adjustment. So let's see how we are going to deal with this adjustment. Now the 4 million we will need to add it to our property, plant and equipment. So we will add 4 million to our property, plant and equipment, and under non-current liabilities we will have the decommissioning cost, which is going to be 4 million. Then this will also have an impact on the net assets of our company. So the net assets of our company, we will have the share capital. Now on the acquisition date as well as on the reporting date, the share capital will stay at 20,000. Then you need to take your retained earnings. So your retained earnings as of the reporting date is going to be 19,000 plus the profit for the year 8,000. So altogether we'll be looking at 27,000. As of the acquisition date, we'll calculate it later on. Right. So we can take the new assets that is coming in. So the decommissioning, so the new asset is going to be added to the acquisition date as well as for the reporting date. So it will be at 4 million. And also there is going to be a provision coming in. So it is a liability. So if it's a liability, that means your net assets are going to decrease, because your net assets are your total assets minus the liabilities. So you'll have to remove 4,000 for the decommissioning cost. So if you look into the net effect of this, you will see it's 0, right? Because you're recognizing an equal asset as well as a liability. There is no impact on the net assets because due to this part of the transaction, right? So we are done up to that point. Now we need to take the depreciation on the decommissioning. Now the asset is going to have a value of 4 million and the useful economic life is going to be 5 years. So I need to allocate this 4 million over 5 years. So the annual depreciation that I need to take is going to be 4 million divided by 5, that would be 800. However, we have only acquired this company 3 months ago, so we only need to take 3 months of depreciation. So 800 into 3 over 12, 200 is going to be the depreciation that is coming in. So we need to reduce our property, plant and equipment by 200 because of the depreciation. This will also have an impact on your net assets as at the reporting date. So you'll have the depreciation of decommissioning cost. I'll put it as DC. So that's going to be 200. So this is an expense. So this will reduce your profits or your net assets. So we have dealt with the depreciation of it. So that's done. The next is to deal with the finance cost component. So we need to unwind the discount. The annual amount that you will be taking is, this asset is at 4 million. That into, we have taken the net present value at 8%, so 4 million at into 8%, so that will be 320. However, we need to take only 3 months, so 320 into 3 over 12, 80 is going to be the amount that we need to take to the finance cost as a part of unwinding it. So what happens is my decommissioning cost, the liability will increase by 80. So my decommissioning cost liability will be 4080, and this will be adjusted in my profits because my finance cost is increasing. So we will reduce 80 as an expense, right? We will be unwinding the discount component. So with that, we have finished all the workings for the first note. Second one, Dargent cost policy is to value the non-controlling interest at the fair value at the date of acquisition. Lottery cost share price at the date can be deemed to be representative of the fair value of the shares held by the non-controlling interest. Now, in the question earlier on, they gave us the share value of Lottery Co, which stood at 1.8. So we'll have to use that 1.8 to calculate the value of the shares or the NCI, the fair value of the NCI. So the NCI fair value on acquisition, we have 5,000 shares because we had 20,000 shares on Lottery Co. So out of that, we took 75%. The remaining 25% is going to be taken by NCI. So that is going to be 5,000. So it will be 5,000 shares multiplied by 1.8. So 9,000 is going to be the fair value of your non-controlling interest. So with that, we are done with the second working as well. Third one, the inventory of Lottery Co includes goods bought by Dargent Co for 2.1 million. Dargent Co applies a consistent markup of 40%. So if we are going to have a consistent markup of 40%, this basically means you will have cost of 100%. To this, we will add the profit, which is going to be 40%. So the selling price is going to be 140%. So this 2.1 million is the amount that Lottery Co has paid, right? So this is the selling price that you have got. So you will have to take the unrealized profit within this closing stock. So the unrealized profit, the closing stock is 2.1 million. So the URP on this closing stock is going to be 2.1 million into 40 divided by 140, because this 2.1 million is 140%. We only need to look at the profit component, which is that 40%. So 600 is going to be the URP that is coming from the closing stock alone. We are not yet done with the adjustment, so we'll finish the adjustment and then we'll start recording these figures on the statement of financial position. On 20th March of 2006, Dargent Co. dispatched goods to Luttree Co. with a selling price of 700,000. These were not received by Luttree Co. until after the year end, so have not been included in the above inventory at 31st March 2006. So this is goods in transit. You need to record this in the inventory of the organization. So the inventory needs to get debited by 700,000. And you need to show these under the payables, which will be credited by 700,000. So my inventory is going to increase by 700,000 and my payables will also increase by 700,000. So let's go to the statement of financial position. My inventory, let's add that 700,000. Then you go to your current liabilities and let's add the 700,000 to that as well. Right. So we have completed this part of it. Now we have a new set of inventory coming in. So there is going to be a unrealized profit coming from the goods in transit. So the value of the goods was 700. The unrealized profit that you would see there is going to be 700 into 40 divided by 140, just like the last time. So you will see a unrealized profit of 200. So altogether you will see a unrealized profit of 800 coming in. So this unrealized profit of 800, we need to adjust it from the inventory. So we will remove 800 from the inventory. And we need to see who is going to be the seller, so that we can adjust it in the retained earnings or under net assets if the subsidiary was a seller. Here in this case, Luttree Co. is buying the goods from Dargent Co. So it is the parent who is selling these goods. So you have to adjust it on the parent's retained earnings. So the URP adjustment, the unrealized profit adjustments, so that is going to be 800 coming on the parent's end. So we have completed the URP adjustment as well. Right. Next, at 31st March 2006, Dargent Co.'s records showed a receivable due from Luttree Co. of 3 million. This differed to the equivalent payable of Luttree Co.'s records due to goods in transit. So this difference is already set off once we recorded these goods in transit. So we have 3 million, which is intercompany trade receivable and payable. So this has to be removed from your consolidated financial statements. So we will remove 3 million from my trade receivables as an intercompany receivable, and from my trade payables or my current liabilities I will remove 3 million, which is the intercompany payable component. Okay, so we are done with that adjustment as well. Then the fourth one, the investment in Emery Co. represents 30% of its voting share capital of Dargent Co. Capital, and Dargent Co. uses equity accounting to account for this investment. Emery Co.'s profit for the year ended 31st March 2006 was 6 million. So Emery Co. is making a profit of 6 million. Let's have a working coming for Emery Co. This is an associate that we have. So let's put up a working for Emery Co. which is for our associate. So the profit for the year of the associate is going to be 6 million, out of which they paid a total dividend for the year of 2 million. So dividends paid is going to be 2 million. Dargent Co has recorded its share of dividend received from Americo in investment income. So you don't need to account for the dividend again. It's already been accounted for. You need to account for the unaccounted component, which is the 4 million, the post acquisition, the gains that you have. So out of these gains, we will receive 30% because we have 30% ownership, right? So 30% is 4,000 into 30%. That is going to be 1,200. So the investment in the associate, according to the statement of financial position, the investment in the associate is 4,500. To this, we need to add the growth of associate, which is 1,200. So now the value of your associate is going to be 5,700. So your associate, you will be showing at 5,700, which is coming from working number 6. And the share of profits, we need to show it under our retained earnings. So this is again a profit that your parent has made. So share of associates is going to be 1,200. So this will increase your VAT. You need to take that 1,200 in. So with that, we have taken the information from note adjustment number 4 as well. So we are done with it. Fifth one says all profits and losses accrued evenly throughout the year. So this was given to us to calculate what is our retained earnings. So my retained earnings on acquisition so the retained earnings as at 1st of April 2000x5, that is going to be 19,000. Now we have only had ownership for 3 months, so that means the remaining 9 months we did not have ownership on the subsidiary. So the subsidiary has made a profit of 8,000, so that into 9/12. So the profits that was made before we have acquired lot 3 is 6,000. So the retained earnings of lot 3 Co before on the date of acquisition is going to be 25,000. So this will be taken to working number 2. So lot 3 Co is going to have 25,000 retained earnings on the date of acquisition. So we are done with that, and there is no impairment coming in. So there is no impairment of goodwill or anything that we need to do. So with that, we have taken all the information. So now we need to move on with the workings. So your net assets on the date of acquisition is going to be 45,000. On the reporting date, it's going to be 46,720. So you will be taking the growth which is 46,720 minus 4,500. The growth is going to be 1,720. So with that, we'll start with the goodwill working. So we need to take the investment that was made. So in shares, the investment that we made was 32,000, and in loan notes we made an investment of 15,000. So 32,000 in shares, in loan notes we have 15,000. So our total investment is going to be 47,000. To this we need to take the fair value of the non-controlling interest, which we calculated to be 9,000. So the total investment that was made is 47,000 plus 9,000, that will be 56,000. Then the net assets on the date of acquisition. So the net assets on the date of acquisition, that stands at 45,000. So the goodwill is going to be 56,000 minus 45,000, that will be 11,000. So it's not impaired, so we can straight away take goodwill, which is going to be 11,000, and coming from working number 2. So with that it's coming from working number 3. So with that we are done with working number 3. Let's move on to working number 4, which is the non-controlling interest. We need to take the growth. So 1,720 was the growth of the subsidiary. From that, the NCI is going to get 25%. So 430 is what the NCI is going to receive. So 9,000 plus 430, 9,430 is going to be your NCI. So under your non-controlling interest, you'll be showing 9,430. Next, we'll be going to working number 5, which is your parents group retained earnings. You need to take it from your, the parents retained earnings, you need to take it from your statement of financial position. So 20,000 plus the current year's value of 16,000. 36,000 is going to be your parents retained earnings. We need to take the subsidiaries growth, so share of lottery. So 1,720 was the growth of lottery co. From that we get 75%. So 1,290 is going to be the growth of lottery co. So with that we are done with working number 5. So 37,390 is going to be your retained earnings. So under your retained earnings, that 37,390. The associate, we showed it at 5,700, so that working is already completed. So now we need to finish our statement of financial position. So 191,300 is going to be your total assets. Total of equity, $128,820. Total of your non-current liabilities is going to be $24,080. Your current liabilities in total is $38,400. So the total equity and your liabilities be $191,300. Okay, so your financial statement balances at $191,300. So guys, this is the answer for question number 32, March June 2017 past paper for ACCA F7.